Petty cash funds, as stated by the ACCT financial textbook, is an amount of cash kept on hand to pay for minor expenditures and is one of the best assets for demonstrating internal control within an organisation. Petty cash is a form of immediate payment that allows businesses to pay for small expenses quickly. Petty cash is stored in easy-to-access places and finances the miscellaneous expenses of a business. Step 1. Establishing the fund. The first step we take in a petty cash fund is to establish the fund. To establish the fund, we first make a check for the amount required in the fund, cash in the check, and then place the money in a secure location under the supervision of a trusted employee. Step 2. Making payments from the fund. There are 2 ways for this fund to be used. The first is for quick expenses such as postage costs, and the second is to compensate employees for their out-of-pocket expenses. Usually most businesses require a receipt as proof of the expense and to keep track of cash expenditure, as payments using petty cash are not usually recorded in the journal. Step 3. Replenishing the fund. As a business constantly makes payments from the petty cash fund, there will be an eventual need to replenish this. The current fund is counted and the business cashes in a check that will restore the fund to its previous amount. An example of establishing the fund. Take the example of a local business, Flowers Delight, who cashes in a check for $150 on July 1st. This would be recorded as follows. The petty cash is debited and increases by $150, while cash is credited and decreases by $150. When establishing the fund, the assets do not increase or decrease, as the cash is simply being classified into a petty cash fund and the business still retains this cash asset. An example of replenishing the fund, where the manager of Flowers Delight would examine the petty cash fund and prepare a statement. The report for Flowers Delight shows that there has been an expenditure of $50 from the petty cash fund, meaning that the fund needs to be replenished by $50 to be restored to the original amount of $150. In order to replenish this fund, the manager needs to cash a check and record the expenses. This journal entry shows the expenses and how much cash is needed to replenish the fund, so we need to credit cash as it is decreasing. This also means that assets are now decreasing as the fund is being restored and not established. In some instances, when we replenish the petty cash fund, not all the expenses total the final amount required to return the fund to its original amount. This is called cash over and short, where sometimes not all receipts for expenses can be obtained or incorrect sums are given. This account is temporary and its purpose is to make up the balance. An example of this would be as follows. As there is an amount of $3 missing from the replenishment report, we record this in the journal. We add another account called cash over and short and put the required balance in there in order to replenish the account to its original amount.